All right. Good evening, everyone. I hope you can hear me well. Good, very good. Um, I'm gonna try. I'm not sure the microphone is working, so I'm just gonna make a quick technical change. Um, all right. Let me see. Just making a quick change on the computer, if you don't mind. All right. There you go. I think it should be better this way. Okay, so as I usually uh, do, I think it's a good idea to make some sort of summary of what we did yesterday. So I'm going to take 5-10 minutes to do that, just to remember summary of yesterday's class. By the way, I've put the share notes uh, on your folder, right, so that you can access them. I think it's additional material that's helpful, I think. So, what did we do yesterday? First of all, we started with an exercise on, on open market operations. I'm not going to come back on this. But importantly, we discussed the difference uh, between the commercial bank and the central bank in the way they create money. Right? And we've realized that they are um, commercial banks are facing legal constraint. Right? They are limited by law in the monetization operation can do. Right? It's monetizing loans and monetizing foreign currency. Central bank, although there usually is a legal frame framework defining what it cannot do, they have much more room for monetization. Right? In particular, they can buy securities for themselves, creating their own money. But commercial banks can buy securities, obviously, but they're going to have to use their own resources, right, or their customers' resources. They cannot create money for themselves and buy securities. That's one difference. And also, another difference is that there is no reserve ratio requirement for central banks. I'm going to put an exclamation mark here. In the sense that nobody is telling the central bank when to stop creating money. As you can see on your screen right there, right inside, nobody told the Fed uh, they should stop create money, right? And if we move back a little bit, uh, this maybe it's later. The statistics. Yeah, it's slide number 36. I'm going to go back to slide 36. As you can see, M0, for instance, was growing very smoothly, like very smoothly. I mean, we're talking about 1984 here. So very smooth growth, and then suddenly bang, right? So there's nobody is telling central banks what they should when they should stop creating money. So I think that's one key difference with commercial banks. Okay. Then I give you show you some data on M0 and M1 in the US. Very spectacular increase after 2008 financial crisis. What else did we do? Yes, we discussed, that's important, we discussed endogenous limits to money creation, right? The fact, which is the fact that banks need to be careful in their loan decisions, right? In particular, they cannot do too much, otherwise they will be permanently hit towards other banks, bank payment in particular, and also because they don't want to lend to um, um, how can I say that? To people without the means, right? That's one idea. Um, so bottom line, so banks cannot lend too much for those reasons, right? But too little as well. This you're gonna see that this played a role in the 2008 financial crisis in the US because many banks were very optimistic in their assessment of their customers' ability to pay back. Therefore, they provided a lot of loans. And also, it's very difficult for a bank to step back, to step aside, and look at all your competitors providing credits to everybody, and then you being on the sideline and then not providing credit by thinking that this is going too far, this is too dangerous, there's too much credit going on, that's going to be trouble down the road. It's very hard for a bank, right? When all your competitors are creating a lot of money, getting customers, making money, to step back, to say, stop, this is going too far, there's going to be trouble down the road. So you will do just like everybody does, right? That you will make loans to your customers when they ask for it. Okay, so that's why I say that banks cannot lend too little either, because if they do, if they keep rejecting loan applications, then customers are going to move. So that's very important. We also talked about the exogenous limits to money creation, and that's pretty much monetary policy, right? Monetary policy, mostly three tools: discount rate, operations, reserve requirement ratio. Okay. So I like this distinction between exogenous and endogenous limits, right? One endogenous means coming from inside, coming from within, right? That's the banking business is such that banks want to maximize profit. Maximizing profit doesn't mean maximizing loan, the loan portfolio, because you want to lend to people that have the ability to pay back. An exogenous limit means exo means outside, from outside. So from outside the banking industry, there are limits that are being imposed upon by the central bank. Okay, and importantly, is controlled by the central bank is only indirect, right? In the sense that all the central bank can do is try to influence agents' economic decisions. That it cannot make the decision for them. Okay? In particular, if interest rates are very high, but agents are still happy to borrow at a very high interest rate, as I explained yesterday in the case of Australia, for instance, and then there's nothing you can do, right? You're trying to cool down the economy, but if people are happy to borrow at very high um, exchange rate, there's not much you can do, right? And finally, we did an exercise on central bank bond, on loan to government from the central bank. So and finally, yeah, we also look at real commercial bank and central bank balance sheet, and we realize they are very similar to the one we've been working with in our exercises. Okay, they're just a few anecdotal items here and there, but not much. Okay, so I guess that's it for the summary. Before we move on, I'm happy to take a question, perhaps, on anything we did yesterday and you would like me to come back on. All right, it looks there's no questions, so we're gonna move on. So I'm just gonna read the slides. They're kind of summary slides, so it's good to read them. Banks make a living by producing their own money and lending it to you. They compete for customers. Competition drives borrowing rates down and lending rates up. Yeah, obviously, the more banks you have, the more competition there is, and it's unlikely bank would be able to collude on a high interest rate. There's always a bank that will undercut the competitors, that will offer a slightly lower rate, and by doing so, it will be able to grab a large share of the market. So competition plays an important role in keeping interest rates low on loans and high on savings. As we just discussed, there are endogenous and exogenous limits to that process of money creation. On average, more money is created than destroyed, so the quantity of money increases with time. Intuitively, the more the money stock has to increase roughly in proportion with the GDP. If not, there's something wrong. If the ratio of the money growth rate to GDP growth rate increases, there should see inflation, unless there is some technological change that increases or decreases the velocity of money. So what this slide is about is just trying to remember that we keep talking about money creation, but there's always the other side of the story, which is money destruction, right? And in particular, when a loan is being paid back, okay, at security could show that to you. It's very simple on the balance sheet. Um, I'm going to shift to the blank one, and like a simple balance sheet. Maybe that one. So assume this is a commercial bank, right? Commercial bank. And assume the commercial bank provides a loan, gives a loan to someone, $10,000 loan. The deposit will increase. Okay, so deposit is 10 grand. So the grand total has also increased by 10,000, right? You know that. That's because of the loan, right? There is nothing new here. What I'm trying to explain here, what happens when the loan is paid back. When the loan is paid back, right? For instance, just for the sake of simplicity here, I'm just going to assume that the customer changes his mind. Okay, he said, "I want a $10,000 loan." The bank said yes, and then he said, "Well, okay, I changed my mind. Actually, I got the money from somewhere else. I earned it through my work on financial markets, whatever. So I don't need this. I don't need that loan anymore." So what do you think is going to happen? Well, he's going to pay back the loan. How is it going? Oops. How is he or she going to do that? Well, he's just going to use the money on his account and pay it back. Okay. So that means the loan's going to disappear. So now we are back to square one. Okay. Okay. That's how it works. Okay. You can see in that operation, uh, money was created and then it was destroyed. That's as simple as this. Okay. This is so that's the reason I'm saying this, because I don't want you to think there's always new money adding to the pie, right? Some of you probably have a mortgage, a home loan, or a loan to buy an apartment in Ho Chi Minh or in Hanoi, perhaps a house. Well, I'm sure you're paying it back little by little, right? So every time you're paying it back, the loan amount on the asset side of the bank decreases, and on the liability side of the bank, your bank account decreases by the same amount. Okay, so but uh, the net between money creation and money destruction is to be positive. Okay, roughly in proportion with the growth rate of the GDP. That's what this slide is all about. Okay, unless you're entering recession, and in a recession, that's a different story. In a recession, the economy is shrinking, so probably the credit is has stopped. Okay, so that may be a time when the money supply, so the credit creation has stopped, but people keep paying back their loan, right? So their money is being destroyed. So, but if you, let's have a look at some statistics precisely. So this is the US here, and this is Europe here. And in blue you have M1, and in red you have GDP. They're all in nominal figures, right? So you can see that they tend to be moving together. There was some kind of a change here, and we're talking about the mid 90s. That's probably due to an increase in the velocity of money, right? The fact that the money was perhaps circulating faster, and if that's the case, and then you don't need as much money, because the same you need the same bills, for instance, will be used more often. And in Europe, you have this sort of something similar, some sort of both are growing similar. Okay, so it's not always true. It's not a one-to-one relationship. All I'm trying to say here is that even though some money is destroyed when the loan is paid back, because there's always some new loans being granted, the money, the net amount of money in the economy increases roughly in proportion with the GDP. That's what I'm saying here. Okay, so all right, so we've done quite a bit of work here, right? We concentrated on the main mission of the central bank, which is about conducting monetary policy through a more discount rate, RRR, as a way to influence the quantity of money. There are other missions that the central bank fulfills, and that's what we're going to study now. Okay, the other missions of the central bank, and there are two actually. The first one is called foreign exchange market interventions. Okay, so in many countries, I'm not too sure about Vietnam. Probably it does. I'm sure it does. In some in many countries, especially small countries, the central bank will try to influence or keep the exchange rate of the currency within some sort of corridor, within some sort of fluctuation path that is okay, right? So typically, for instance, in Vietnam, the central bank will try to prevent the Vietnamese dong from depreciating too much, okay? And in order to do that, the central bank will intervene on the foreign exchange market. Okay, so we call that forex interventions. Forex is a contraction for foreign exchange market, right? The forex is, I'm sure you know that. This is where currencies are traded, right? So, for instance, you can buy US dollar in exchange for euros, Australian dollar in exchange for Japanese yen, this sort of thing. Okay, this is all done on the foreign exchange market, which we also call the forex. Okay, and as I said, so most players on the forex are actually private agents, and in particular banks, big companies, big firms, investment funds, insurance companies, all institutions that are in need for some sort of currency, right? But on top of those institutions and private agents, the central banks can interfere on the market as well in order to try to influence the value of their own domestic currency. For instance, in the case of Vietnam, I told you the SBV may want to prevent the Vietnamese dong from depreciating too much. To do that, it would have to um, to buy the Vietnamese dong on the foreign exchange market and sell some of its foreign exchange reserves, right? So typically, the Central Bank of Vietnam will have accumulated over time foreign exchange reserves in the form of Australian dollar, US dollar, euros, perhaps Chinese yuan as well, Singaporean dollar. And those are reserve, foreign exchange reserves, right? They are on the asset side of the SBV. And they can use, if they think the Vietnamese dong on the foreign exchange market is depreciating for some reason, too fast, they can try to buy it back, right? So they're going to sell some of the foreign exchange reserves. They're going to sell some of their reserves in US dollar and buy back the Vietnamese dong on the forex. Right? By increasing the demand for Vietnamese dong, they will push up the price of the Vietnamese dong. Therefore, the Vietnamese dong will appreciate. Okay, that's one example. That's one example. But it can work the other way around. Okay, for instance, let's talk about China now. China does exactly the opposite. Okay, why is that? The problem in China is the following. And it's not really a problem actually, but the way the government, the Chinese government sees it, they see it as a problem. But how does it work? So in China, because China is a net exporting country, right? I'm going to move back to share notes. So China is a net exporting country. That is, its exports are greater than its imports. To buy Chinese goods, Americans and Europeans need to buy Chinese yuan most of the time. This triggers an increase in the demand for Chinese yuan, which translates to appreciation of the Chinese yuan, right? The problem with an expensive Chinese yuan is that it can harm Chinese exporters because Chinese products are becoming more expensive. So the People's Bank of China, they want to prevent the Chinese yuan from appreciating too much in order to protect Chinese exporters. How to do that? By selling. So that's the opposite to my Vietnamese example. But Chinese, by selling Chinese yuan in exchange for foreign currencies, USD, euro, yen, etc. Okay. The problem with that operation is printing. We put that in quotation mark. They're not really printing. They're just crediting the bank's account. With printing new Chinese yuan is that the Chinese money supply increases, right? One way to prevent that from happening is by buying back some of those extra Chinese yuan by selling bonds to Chinese banks, right? On the one hand, they print Chinese yuan. Wait, remember, central banks can do whatever they want, right? Let's go back to blank. Do I have a central bank balance sheet somewhere? What is? Assume this is a central bank now. Say central. If the central bank wants to buy foreign foreign currencies, I'm just gonna have to look foreign currencies. I don't know, plus 1 million. We're talking yuan here, so I'm gonna put what's the what's the symbol used for the yuan? I'm gonna look that up on the web, unless you guys know it already. Symbol for yuan. Oh, it's complicated. I will not be able to. I won't find that on my keyboard. I'm just gonna put yuan there. Yuan. Yeah, that up. Make it smaller and do it again. Okay, so foreign currency. Let's say I need an exchange rate here. So USD to yuan, that's 6.5. Okay, so I'm gonna put yuan 6.5 million. Okay, that would correspond to the purchase of 1 million USD. Okay. Why? Because I told you the exchange rate is USD 1 equal yuan 6.5. Okay. So the central bank is buying 6.1 million US dollar, which is worth 6.5 million yuan. So therefore, it's buying it from some commercial bank, right? So we're going to have a commercial bank deposit. We're going to have plus dollars. It's yuan. China. Yuan 6.5 million. Okay. So I'm going to make that clear by saying this is the People's Bank of China. Okay, you guys understand what's going on here? I'm the Chinese central bank. There's a lot of foreign currency flowing into the economy because it's a net exporter. So what you want to do as a central bank is you want to prevent the Chinese yuan from appreciating too much. So what you're going to do, you're going to buy back some of those foreign currencies from the banks and supply Chinese yuan. So you're going to create Chinese yuan. Okay, that's exactly what we have here. Okay, so in the total, if we look at the total here, we're going to have plus 6.5 million. Okay, plus 6.5. I'm going to move back to the main slide. Oops, I don't want to do a poll. I want to move back to the main presentation and to the share notes. So as we were saying, So let me read that again. Um, China. Okay, so China is an exporting country, right? It's a net exporting country, just like Germany. Its exports are greater than its imports. But to buy Chinese goods, Americans and Europeans need to buy Chinese yuan first, most of the time. This triggers an increase in the demand for Chinese yuan, which translates into an appreciation of the Chinese yuan. The problem with an expensive Chinese yuan is that it can harm Chinese exporters because Chinese products are becoming more expensive. So the People's Bank of China may want to prevent um, the Chinese yuan from appreciating too much in order to protect Chinese exporters. How to do that? By selling Chinese yuan in exchange for foreign currency. So if you do that by supplying Chinese yuan and buying back foreign currencies, the Chinese yuan will depreciate because you increase the supply of Chinese yuan and you increase the demand for US dollars, right? The problem with this operation, and that's my point, with printing new Chinese yuan, just like we did with my 6.5 million Chinese yuan example, is that the Chinese money supply will increase. One way to prevent that from happening is by buying back some from some of those extra Chinese yuan by selling bonds to the Chinese central bank. Okay, so I can see there's a comment here, a question. I'm just going to finish reading the slide and then I'm going to take your comment. So when central bank buys some foreign currency or gold, there is a corresponding increase in base money and vice versa. This can be done when it wants to alter the exchange rate. Switzerland in recent years, but China as well. Central bank can pair, that's an interesting verb here. Associate, that's what it means, can associate foreign exchange purchases with offsetting open market operation to avoid changing the amount of base money. And those operations are called sterilization. Okay? And that's exactly what we're going to do now. So let me go back to the public chat. Hi, Prof. I know that China have two types of currency, Chinese yuan and what is that? CNH. What does that mean, Chinese? The renminbi. I see there's a difference because one is used in mainland China, the other one in Hong Kong. So why do they do that, and what will the central bank do to intervene? So I'm no expert here, so I don't want to talk too much about this. My guess is that I'm not too sure. I'm gonna stick to my Chinese yuan example, right? And I'm gonna try to clarify the difference between the two. Then I'll come back with an answer. Okay? I'm sorry, that's all I can say at this stage. Okay. But next slide, by the way, is about China. So let's read it together. So example of sterilization, the People's Bank of China. The People's Bank of China's mandate is defined in the People's Bank of China Act as to maintain the stability of the value of the currency and thereby promote economic growth. That's Article 3. At the same time, the People's Bank of China's monetary policy is entrusted to guard against and eliminate systematic financial risk and maintain financial stability. The objective of financial stability is reflected, among others, in exchange rate stability as well as credit control. So you see, this is specific to China. I wouldn't be, I think in Vietnam you have some sort of it's relatively similar, but for instance in the US or in Europe there is no provision with regards to exchange rate stability. Okay, this falls completely outside of the central bank's mandate. Okay, but in Europe the only mandate of the central bank is to maintain price stability. In the US, it's a dual mandate. Let me write that word for you. Dual mandate. In the sense that in the US, they have the Fed has a dual mandate in the sense that it has to look both at low inflation, so price stability, and also full employment. Okay, so it's what we call a dual mandate because it has two objectives, right? In China, there are quite a few objectives, right? There are Article 2, 4, etc. But one of them is exchange rate stability. So that gives it the ground to intervene on the foreign exchange market precisely to prevent the Chinese yuan from appreciating too much. So the current the current managed floating rate regime is +3 -3% daily. So that means the central bank will not let the yuan move beyond that corridor. Okay, that's another interesting word for you, a corridor. I invite you to look it up in the dictionary. What does that mean? A corridor, it's kind of something like this, a tunnel with an upper a ceiling. That's the ceiling and that's the floor. And the exchange rate can move within but cannot exit that corridor. Okay, that's what we need. So here in China, it would be +3 -3% daily. Foreign exchange purchases to prevent the yuan from appreciating too much translate into growing forex reserves. Yes, we've seen that. Look at that. Let me go back to the blank one. By doing so, obviously, the Chinese central bank will accumulate a lot of foreign reserve because it is in the form of US dollars, right? The reason I've written yuan, we had this question early on in the class, because this is China, so they have to register everything in yuan. Okay, it cannot be anything else. But they actually bought US dollars, right? Foreign currencies, right? So you see, by printing money, by issuing, by buying back those foreign currencies from any institution, here it's commercial bank, but it's not necessarily a commercial bank, by buying foreign exchange reserve, not only the central bank balance sheet is expanding, but it's also accumulating a lot of reserves, right? A lot of foreign exchange reserve, and it's huge. And in China, we're talking trillions, right? That's a lot of zeros, a trillion. That's 1,000, 1 million, 1 billion, 1 trillion. You see? That's a lot. I think in China that we're talking 2 or 3 trillion in terms of foreign exchange reserve. That's a lot. That's a lot. Okay, let's move back to the main presentation. Foreign exchange purchases to prevent the yen from appreciating too much translate into growing forex reserves. The resulting excessive liquidity is withdrawn using 3 sterilization tool, and that's what I'm trying to explain here. Repo transaction, the central bank sells securities for cash to banks for a very short period of time. Yes, that's what I was saying when I was saying they were selling securities, right? So to summarize the story of sterilization, it goes like this. The central bank buys foreign currency in exchange for its own domestic currency in order to prevent the domestic currency from appreciating. To offset the increase in the domestic money supply, the central bank at the same time will sell securities to the commercial banks in order to remove some of the base money. And by doing so, they can offset the forex intervention. Okay. The other way of doing so, where is that? The other way of doing so is by issuing central bank bills. We've done that as well. Yesterday, remember, when the central bank issues a bill, that's one way of removing liquidity, because that money is now in the form of a bill rather than the form of cash, and it's all playing out on the liability side of the, the central bank. Remember the exercise yesterday. And finally, by increasing the reserve ratio. Okay, you cannot see it here, perhaps it's a bit crumbled. All right, so now it's time to do next. Here's a question: why does repo transaction have to be for a very short? It doesn't necessarily have to be for a very short period of time. I guess that's the way the Chinese do it. You can have any maturity you want, but it's typically a revolving operation. So when it matures, they're going to renew it. Um, the point of all this is to remove liquidity. So I guess you want to make sure the maturities are not too long to make sure that it's liquid. The market is liquid enough, and you don't have that much resources that are being stuck in some long-term financial product. Perhaps that's the reason. Okay, and that's my guess as well. Okay, so now I think would be a good time to do precisely that, an exercise on this on those sterilization operation. Okay, so let's read this exercise together, and then I'm going to allocate you into breakout rooms. So we're going to take a central bank and a commercial bank with the following simplified balance sheet. So those are next slides. So let me comment briefly on that. So we have a commercial bank with some reserves. I'm going to put that in red. We have the commercial banks that has some reserves. We know that, a loan portfolio, some securities, and some foreign exchange currencies. Okay, and that's for a total of 220K. On the liability side, we have the same amount of deposits. Okay, if you look at the central bank now, it has quite a bit of base money outstanding. The bulk of it being in exchange for securities, but there's some fraction of it is foreign currencies for a grand total of 1.1 million. Those are far from realistic numbers, but we don't really care. We care about understanding what's going on. So, what are the questions now? Assume that the People's Bank of China buys for 1 million Chinese yuan worth of USD. That's important, right? It's not buying Chinese yuan. The People's Bank of China cannot buy Chinese yuan because it's issuing Chinese yuan. Okay. What it can buy, I guess it can buy it with foreign currency, but that's not what I'm talking about here. I'm saying assume the PBC buys US dollar worth 1 million Chinese yuan from a Chinese commercial bank in order to prevent the Chinese yuan from appreciating too much. Represent the central banks and the people banks of China balance sheet after this operation. Second question, assume now that the People's Bank of China wants to offset the corresponding increase in the Chinese yuan money supply and sell securities to that commercial bank for the same amount, that is 1 million Chinese yuan. Okay. The PBC is conducting a sterilization operation. Represent the central bank and the People's Bank balance sheet in this operation. Okay. We have a bit of a problem here because there's too much. I've put all the numbers in. I'm going to reduce those numbers. Assume this is all yuan. So I'm going to remove some zeros here. Okay. Up. White. Oops, that's too big. Why? Because otherwise it wouldn't fit with my balance sheet. You understand what I'm talking about here. All right, 1,000 change. I know it's a ridiculous amount, but for the point of the exercise, it's going to do fine. All right. So this in order to illustrate sterilization operations. Okay, so I guess 4 minutes per question. So I'm gonna create breakout rooms, and I'm gonna give you 8 minutes to this exercise. All right, randomly assign. Let's go.
Bao nhiêu? Phí thế này là 530.000 cơ à? Ui dồi, may quá, nó ui dồi, vừa đủ này. Từ từ để xem có tiền lẻ 50 đúng không? Không có đâu.
All right, welcome back. So let us do this exercise together. So we have the People's Bank of China that buys 1,000 Chinese yuan worth of USD from a Chinese commercial bank in order to prevent the Chinese yuan from appreciating too much, represent the central bank and the People's Bank of China's balance sheet. Okay, so what do you guys wanna say here? Is that anyone who wants to make a suggestion on what should happen for the commercial bank and or the central bank? Right, let's to be anyone rushing to answer. So yes, someone is typing now. So I'm gonna wait for the answer to show up. So central bank foreign plus 1,000 basically exactly. So indeed, we have plus 1K for the foreign currencies because it is buying. So and the base money has increased by the same amount. Okay, because it is issuing some base money. All right, so that moves up. Whoops. That goes up. That goes up as well. So I'm going to cross that out. What about, so we're talking about 101K. And here we're talking about 1.0101 million. Okay. And for that's for the second question, yes, but let's finish for the first one. For the commercial bank, so the commercial bank is indeed letting 1,000 yuan go, so it's a minus. Okay, and in exchange it gets some reserve, right? We're gonna put plus 1K, right? So I'm still answering question 1, right? Remember, I'm not done yet. So we have 19. Not gonna have much room to do that here, but let's try to do our best. I'm gonna put that right there. So we're gonna have 41K, 19K. Oh, in the dollar symbol, and that should be yuan. I guess you all figure that out, right? I'm gonna make a comment here. I am using the dollar symbol, but it should be the yuan symbol. Okay. So, but that's no big deal here, right? Okay, so let's finish this at least in red. So in red, I'm doing the first question. So we have 1.101 NNN. Here we have, let's say, 1.101 NNN. Okay, and the commercial bank coin total are not changed. So here, this is the first part of the question. So let me summarize what happened. Okay, we had the central bank that was buying some foreign currencies from the commercial bank. So you can see that the foreign currency is getting out of the commercial bank balance sheet asset side and is lending on the central bank's asset side. And the central bank issued some its currency and paid the central bank with it. Okay, is that clear for the first question? Okay, good. So I'm going to remove those ugly purple drawings, and I'm going to do in green now the second question. So the second question is, well, this is the sterilization operation, right? So the first part is about the buying the foreign currency. The second is about sterilizing, offsetting this increase in the money supply. You see the money supply has increased by 1K. We want to cancel that out. So I told you the central bank will sell some securities, okay, to the commercial bank. So for instance, we're going to have here plus 1K. That's too green. I'm not sure you can see that. That's a bit different color. Perhaps this one in pink. So we can have plus A, right? And we can have for the reserves. Oops, that's going to be messy. So I'm going to line like this just to bring in this direction. So minus. Oh, that's not good. That does not work. Put that here. Minus 1K. We're back to 40. Okay. So let me see if someone had that correct. Yes, central bank securities, you're right. That's sending it. So we're going to have minus 1K here. And also we're going to have minus 1K on the base money side. Okay, minus 1K. Okay. So if we draw a line now, so here we're going to be back to 40. And here we're going to be 101. All right, so let me do this. So here we're back to 40K. And for the securities, we're up to 100. Whoops, that's too big of a rectangle. We're up to 101K. So if we add that up, as you can see, the commercial bank's balance sheet hasn't moved as well. It's still at 220. Okay, and let's look at the central banks now. So now here we are at 999 Ks. Okay. And here we are at back to 1.1 million. Make that clear. Oops. And here's one. So therefore, we are back to 1.1. Okay. It'll be difficult to draw, so I'm going to do that here. 1.1 MLN and 1.1 MLN. All right. That's it. So you see, if you look at the money supply, and I'm going to do that in black now. In the money supply, we are back to square one, as we say. Okay, we're back to 1.1 million. So the money supply has not increased, but we've just substituted foreign currencies for securities. Right? That's for the central bank's money balance sheet. And if you look at the commercial bank's balance sheet, the reserves are again at 40K, that is as it was at the beginning. Okay, but we have a bit more securities and a bit less foreign currencies. So the bottom line, the foreign currencies have been swapped for securities. So that way, the central bank was able to offset. I'm going to write that word so that you can use it. Okay, which means to cancel out. That's the same thing. The increase in the money supply due to the monetization of the foreign currency. Okay, is this clear? Or any question? None? It's clear. Thank you. That's very good. So I want to so perhaps we can move before we make a short break, unless someone is typing. So let me wait for the question or the comment to show up. Why not central bank sell securities and force commercial bank pay by foreign? I see. So you're basically saying, why do we need to go through this base money? Why do we need base? Why are they using base money in this environment? I suppose it would be for some legal reason or accounting reason, in the sense that in China, you pay using Chinese yuan. Okay? And you can, at least from an accounting point of view, you cannot make your purchases in US dollar. Same in France, you have to use the euro. Same in Vietnam, you have to use the dong. What you're telling me is to say, how about a Vietnamese bank paying its employees in US dollars? That would be the same as what you're suggesting. I mean, technically you're right. That would be the same. If you look at my exercise, that's exactly what's being done here. Okay, the reserve, the base money increases, then decreases, so we're back to the original amount. So technically you're right, it's just legal and accounting, right? You're in China, you use yuan. End of story. I guess that's the one. Okay. I see no other reason, really. You're welcome. Second comment or question: what is the difference between HOMO and sterilization? Well, there's a big difference, right? Let me write that here. Back to share notes, perhaps, because it's a good question. Difference between HOMO and sterilization. sterilization is about canceling the effect of purchasing foreign exchange, foreign currencies. One way of doing it is by doing OMO. So there are two different things. Open market operation is about buying and selling bonds in exchange for base money. Sterilization is about canceling. So I can give the definition of OMO, and selling bonds, securities in exchange for base money. It is okay. Sterilization is really about it's a name given, perhaps you could say it this way, it's a name given to a particular type of open market operation whose purpose is related to foreign exchange market intervention. Okay, I would put it this way. It's a type of open market operation. It's a type of money market intervention whose purpose is about canceling some operation that you did on the foreign exchange market. I guess that's the way of putting it. Okay. So they are different. The OMO is sort of the general tool, okay, of interbank market intervention, and you can do it for various different reasons. One of them is sterilization. Okay, that's another way of saying it. Right? Did I answer your question? Okay, very good. So let's move on, and then we're going to make a quick break. I want to talk about central bank as lender of the last resort. Okay, and then we're going to make a break, because I told you the main goal of monetary policy of the central bank is to conduct monetary policy, which is about trying to control the amount of money being created by banks. There are three main tools to do that: reserve ratio requirement, discount rate, and open market operations. And I told you on top of that, typically central banks do two other type of intervention. There's sterilization, foreign exchange market intervention that can be coupled, that can be paired, that can be associated with sterilization. You don't have to conduct sterilization, right? Perhaps I should have mentioned that. It's not compulsory, right? If you're happy with seeing your money supply increase, that's fine. I'm not saying every single foreign exchange purchase is associated with some sterilization operation. I'm not saying that. I'm saying many central banks do that because they don't want the money supply to expand too much. The Chinese do that. The Swiss central bank does that as well. So that's one of the additional missions. The second additional mission is what we call being a lender of last resort. What does that mean? A lender of last resort. That means let's read this together. If one major financial institution has payment difficulties, this puts the whole financial system, and by that I pretty much mean the interbank market, right, in jeopardy, which means at risk. For instance, if Bank A cannot pay Bank B, but Bank B is waiting for that payment from Bank A to pay Bank C, then you can see that the whole banking system becomes in trouble because you're waiting for someone to pay you in order to pay someone else. But if that first person doesn't pay you because it's in big trouble, then you won't get paid. So you won't be able to pay the other guy who might be in trouble then as well, who was expecting this money to pay the other bank, which was supposed to pay you. So you can see there's some kind of domino effect, right? You know that, right? But maybe domino effect. There's one domino that falls, and all of the dominoes are falling. So when financial panic strikes, right, the central bank steps in to lend to the bank in trouble. So in our case, the bank, in my example, the central bank would lend to bank A. Okay? Lender of last resort function prevents spillover effects from one troubled bank to all the other market participants. Okay, so the idea is very simple. On this interbank market, you have quite a few banks, maybe, I don't know, 20 banks in Vietnam, maybe 30, I don't know. If one bank is in big trouble in the sense that it made some poor investment decision, it lost a lot of money on financial markets or whatever, if that bank is in trouble, it cannot pay back its debt on the interbank market, right? It cannot pay the other bank. Therefore, that puts the other bank into difficulties as well, into trouble. And that means that those banks might be in a difficult position to pay the other banks as well. So the whole thing may collapse. One solution to that system is for the central bank to issue money and to provide liquidity to the bank in trouble. We did an exercise yesterday about this. Remember, uh, if you're a bank, you can make. I'm going to clear that out. If you're a central bank, you can make a loan, right, to a commercial bank, right? Let's do that. Loan to a commercial bank. I put 1 billion. How about that? I can do that. I'm the central bank. I do what I want. And if you're not happy, then you can become a central bank. And then you have central bank, commercial banks account. Plus one billion. Okay. That's just, you can do that. You're a central bank. You do what you want. You can issue as much money as you want. Okay. So you've just, and by the way, this is exactly what the Fed did at the beginning. Yesterday, you asked me about this. Well, what's the difference between the green line, the red line, and the blue line? Let's try to find that here. This is exactly this, right? This emergency liquidity, that's right there. Okay, at the beginning of the 2008 crisis, bang, a lot of money being injected into the US banking system exactly through what I've just described. As you can see, this is not OMO, okay? Those are not open market operation. OMO. This is not OMO. This is just an emergency lending, okay? Later on, I told you that later on, the loan were paid back because the central bank moved to conduct QE1, QE2, QE3, which were indeed open market operation, right? Oops, what is that? I don't want to do that. Okay, so that's called lender of last resort. The problem with lender of last resort, and I'm going to talk about that right after the break because we're going to talk about the financial crisis, is what we call the moral hazard. I'm just going to give you the general idea now, and then you can go and grab your tea or your coffee. It's perhaps a bit late to take coffee. Moral hazard means the following. If commercial banks know in advance that if they go into some sort of trouble because they make poor financial decisions, if they know that in that case the central bank will step in and provide them with the liquidity they need, then they will take risks. They will behave badly because they know that the central bank will save them eventually. Okay, let me give you an example. This moral hazards vocabulary comes from the insurance business. Think about the following example: a car insurance. When you have a car in most countries, people will take up a car insurance. And if you get an accident, then the insurance company will pay. But if you don't subscribe to a car insurance, and if you have an accident, then you will have to pay. So my guess is the following. If you don't have a car insurance, I'm sure you will drive way more safely. You will be way more careful, very slow, looking everywhere. I don't want to have an accident, right? But as soon as you have an insurance, well, you can drive a bit faster, take a bit more risk, be a bit more careless. Why is that? Because, well, in case something goes wrong, the insurance is going to help me out. Okay. Well, that's exactly the same for central banks. Central banks, they are pretty much, I'm going to write that up. Central banks are the commercial bank's insurance. The central bank is the commercial bank's insurance company. I guess that's, we can say that. Okay. You're in trouble. Something you need to realize that is nobody will let a bank go down because this can trigger a domino effect, a huge financial panic. So central banks, they don't like to see commercial banks go down. So what they're going to do is they're going to do exactly as I showed you. They're going to do that. They're going to provide as much liquidity as needed uh, to make sure the banks will not go bust. Okay, so that's what we call lender of the last resort. Okay, so I suggest we make a 5 minutes break now. We reconvene at 30, and okay, let's do that. All right, welcome back after this short break. So we're gonna come back on the moral hazard problem very shortly because after this section 2, we're gonna move to talk about the financial crisis. So I don't want to explain it now, but I guess you already understand. But I'm happy to take a question, perhaps. All right, there doesn't seem to be any question coming my way, so I'm going to finish the last two slides. So the last thing I want to talk about is called seigniorage. Seigniorage. So first of all, it's a French word that's being used in English now. Seigneur comes from the word seigneur, which means lord. Okay, and it's kind of the definition of seigniorage. It's a word that they use in English now. They've taken it from French. It means the privilege of issuing the currency generates revenues for the issuer, and these revenues are grouped under the term seigniorage. Okay. So briefly, in the commodity money system, seigniorage was the fraction of the precious metal that was kept by the mint. Sorry about that. Um, let me, and in the fiat money system, seigniorage on base money corresponds to the interest payments and revenues received by central banks on the total amount of currency issued and used to purchase securities. So I'm going to shift back to the blank presentation and move back to a fully blank slide and talk about very briefly seigniorage in the commodity money system. It's very simple. You bring 10 grams of gold to the mint. The mint manufactures 10 coins, each containing 0.9 grams of gold, and give them back to you. Means the mint kept 10 grams minus 10 times 0.9 grams for 1 gram of profit for it. Profit is called seigniorage. Okay? That's in the commodity money system. We don't really care. It's old. Okay, that's what it used to be when coins were made of gold and silver. All right. Now let's look at what a seigniorage is nowadays. So I'm going to actually reuse this slide. I'm going to erase this. Okay, that's ugly. No, I'm going to clean that up. Okay. And I'm going to explain what is seigniorage nowadays. So seigniorage is the revenues. Remember, it's the revenues associated with the privilege of issuing money. So this we're talking about a central bank here. The central bank buys securities for $1 billion. Okay? We're talking securities. Okay, plus $1 billion. So therefore, there would be some commercial banks deposits plus $1 billion. Okay. We know that the central bank can do that. Okay, we know that the central bank can buy any amount of securities it wants. Well, those securities, right? Oops, those securities right there, they're going to be paying interest or dividends, right? They pay interest, dividends. So it's pretty amazing if you think about it. So the central bank has the ability to create its own money and use it to buy securities that will pay interest and dividends. And those interest and dividends is what we mean by seigniorage. Okay, seigniorage corresponds to the revenues associated. Exactly, exactly. This is exactly. I'm gonna use that phrase. They make money by making money. That's very good. They make money by making money. It's pretty amazing, right? They are making money by making money. Exactly. So you issue your own currency, you buy securities, and those securities pay dividends and interest, and that gives you money. So that's great. That's really great. So this is one way. The other way is through loans. It's not as big, but remember we had an example: loans. You can loan to a bank. Okay, this is going to pay interest as well on the commercial bank deposit. So we're going to have another plus. Okay, so now we're talking billions. Right? Pretty nice tool, Canvas, if you think about it. You can do a lot of things. Okay, so another way of making money is by, rather than buying securities, is just by lending money. You lend money to commercial bank, emergency lending, for instance, and they're going to be paying interest to you. Okay, so this is called seigniorage. Okay, so seigniorage in the old days was the amount of metal, of gold and silver that you kept for yourself, and now it's more like the revenues that are being generated by your money printing capacity. Okay, so let me read that again, so maybe it's going to be more clear now. Seigniorage on base money corresponds to the interest payments and revenues received by central banks and the total amount of currency issued and used to purchase securities. Also, but it's not as important, the currency not bought back by the Fed because it was lost, destroyed, or held by coin collectors is also seigniorage. Yes, because if the money, so you issued the money in exchange for some securities, but the guy, the bank or whatever, whoever lost the currency, so he will not be able to buy back the security from the commercial bank. So that means it's also part of the seigniorage. It's more anecdotal. It's not as important as the one I previously described, but still. For instance, in 2014, the Federal Reserve Bank of the United States, which is the US central bank, handed a record nearly 100 billion US dollar in profit to the Treasury. Yes, because the central bank does not keep that seigniorage income for itself. It uses some of it to pay for its own expenses. There are quite a few people working in the federal system, right? The Federal Reserve. But once it's paid its salaries, its expenses, the difference is paid back to the Treasury. And in 2014, we're talking nearly 100 billion, right? That's a lot. Have a look at, for instance, the Vietnamese GDP. I'm sure it's Vietnam GDP USD. It's 242 billion. No, 245. So you see, it's about two-fifths, almost half of the Vietnamese GDP. It's huge, right? It's huge. In the US, secondary represents about 3% of the government revenue on average. Okay. So I guess that puts an end to this section 2. Do you have any question? Before we move to section 3. All right, it looks like there is no question, so we're gonna move to section 3. Right. Understanding recent financial and monetary crisis. So what we're gonna do in this section 3 is we're gonna use all the knowledge that we have built in the previous classes over the week to understand some recent episodes of monetary crisis, and in particular the 2008 crisis. Okay, you're gonna see now it's going to become much clearer in your mind now that we've done all these exercises. So let us start with the great financial crisis, which started in 2008, and some may argue that it's not over yet. I mean, if you look at the size of the Federal Reserve balance sheet, it's so big that it hasn't come back to normal, at least. Okay, so we need to do a bit of history here to understand where this crisis is coming from. The first thing to remember is that there was a stock market crash in 2000 in the US. And that was that was on the Nasdaq. Okay, so let me put a brief description here. Stock market crash, actually the Nasdaq, in 2000 in the US. Why? Because it was the beginning of the internet, and a lot of internet-based new businesses were suddenly highly overvalued on the stock market. And because we're talking new technology, there was a Nasdaq. So you have, I may not remember that. Maybe you were a bit young for that, but nowadays it seems that internet has always been around, right? We grew up with that, but there was a time, believe me or not, when there was no internet, and internet appeared and started to enter into people's life, into households in US in the second half of the 1990s, and a lot of people understood that it's going to change our life. I mean, look at what we're doing nowadays, right? I'm teaching you from my home in France, right? That would not have been possible without internet. Okay, there's so much economic activity, so much businesses nowadays that rely on internet. So when internet first started to exit the military and university environment to become part of people's life, many people realized it's going to change your life. So a lot of new businesses were set up, a lot of new companies. There was a lot of excitement about what was going to happen, right? And indeed, they were right. I mean, some businesses become very successful, like Amazon or Google. So people were very keen, very happy on investing a lot of money into those stocks, into any company that was vaguely related to internet. Okay. The problem is that among those newly created internet-related companies, many were just not really that good, right? Either their main business idea was bad, or the people that were running the company were not very good. So you had a lot of good companies, but you also had a lot of bad companies. And the problem is that all of those companies, good or bad, were highly valued on the stock market because people were anticipating very high profit, very high capital growth, right? Um, so that's why the stock market was overpriced. The Nasdaq was overpriced. And at some point, some people started to cool down and realize that, well, probably a lot of those stocks, they are way too expensive, right? Some of those companies that just not fake, but they're not really profitable. They're not really selling anything. They just pretend. They're not. There's not nothing really good behind this advertisement of being internet and blah blah blah, right? So there was slowly and then suddenly panic sets in into the world of investors, and then suddenly said, well, all of those companies are highly overvalued. Then people started selling, and because prices were when going down, some other people wanted to sell, right? Because they were afraid they would lose. And then suddenly everybody starts selling those stocks from those high-tech companies, internet-related companies, right? So the Nasdaq crashed, right? And I'm going to try to show you the Nasdaq graph, historical, just to give you an idea of what I mean by the stock market crash. Uh, uh, all right. Yes, that one is good. Uh, so how about I'm going to try something we haven't tried yet. I'm going to try to share my screen. That one. Okay, can you see what's so this is a Nasdaq index, right? So it was growing, and then you have this excitement going on during the late 90s, early 2000s. So the very high value of stock prices, and then boom, the whole thing crashed, right? It went very high and then it crashed. So the Federal Reserve Bank, so by the way, were you able to see my Nasdaq graph? Good. So because of this huge stock market crash, the Fed reacted very strongly. Thank you for answering. Reacted very strongly by decreasing interest rate quite dramatically, right? Why? Because they were afraid there would be some sort of liquidity crisis, right? They were afraid that because a lot of people were losing money, um, they would not be able to pay back the money that they own, that would put the banks into trouble. And if you have a bank into trouble, then that means other bank will be into trouble. And that means the whole interbank market may freeze, and that means the whole financial system may collapse, right? So the Fed was very afraid of the stock market crash. By the way, the Great Depression in the 1930s started with a stock market crash, right? So they were afraid something similar would happen. So they decreased interest rate sharply. Okay, but the problem is that So the stock, if you look at the stock market, let me see what's the next slide. So if you look at the stock market, the Nasdaq, as I've just shown you, so that would be the Nasdaq, and that would be time. So the Nasdaq went pretty much like this, right? And then it moved back up. So the thing is, it was not that bad actually. The stock market crash didn't have that much of an impact on people's wealth. Why is that? Perhaps because people bought around here and they sold around here. So yes, they had, as we call, paper profit, profit on paper, because when it went that up, but because they didn't manage to sell here, they didn't realize any profit, but they didn't realize any loss either. Why? Because perhaps they bought relatively early on. Anyway, what I'm trying to say here is that this Nasdaq crash was not that bad actually. However, if you look at the interest rate, right? This is the federal funds rate. So we're talking about the discount window here. But we know that it's roughly the same as the interbank market. Look at that. Before the stock market crash, the interest rate was roughly around 6.5%, right? And then they decreased the interest rate to 1% because of this crash, right? But if you look at it, this was the lowest interest rate since pretty much the early 1960s. So it was an extremely low, I'm going to put that here, extremely low interest rate environment in the US throughout the 2000s, right? Yes, they started pushing it back up, but it was a bit late, I would say, probably a bit too late. And at least half of the decade was a very low interest rate environment. And even when you start raising it, I mean, just look at here, right? So that's still pretty low, right? And we're talking about 2006, right? 2006. So you had a very low, extremely low interest rate environment in the US throughout the 90s. So what were the consequences of that? Well, as a result, there was a lot of lending going on. Yes, because interest rates are low, people say, well, I can borrow money. And in particular, they invested into housing. Right? That's the beginning of the housing market overvaluation. Second, because we had a very low interest rate environment, we had a lot of capital misallocation, right? Remember what we said about the cost of inflation. When prices change too often, people get confused and they make poor economic decisions. Well, but that's the same for interest rates. I'm tempted to say, right? If the interest rate changes too much, then people may overreact, right? If you look at the US, for instance, interest rate was moving up and down, yes, but it was still positive in a sense, right? But then now we're talking about something very, very low, right? So people overreacted. They bought too many houses. They invested into whatever. Also, there was excessive risk-taking by banks, hedge funds, and so on. Why is that? Well, precisely because interest rate was low. So it was very cheap to borrow money from the central bank or from the interbank market and to invest that money. Money was pretty much free in a sense, right? So we have low interest rates, free money, nearly free money, very, very cheap base money. House prices were going up. Everybody was very excited about the fact that financial assets were appreciating, housing was appreciating. So there was some sort of very optimistic view, right? So all banks were creating a lot of money, right? They were lending to anyone. This is some statistics, for instance. You have total credit to private non-financial sector as a percentage of GDP. If you look at the 2000 decade, so you see it was growing relatively normally, a bit of a spike during the 80s, and it was pretty flat throughout the late 90s, the late 80s up to the early 2000, and then a big spike in credit as a percentage of GDP. Well, that's exactly a result of this low interest rate environment, right? This is exactly the consequences of that. Okay. So let's go back there. So the roots of the 2008, so you know how it ended up, right? In 2008, there was a big crash. Why is that? Because we're going to talk about that, but there was too much money being invested in the housing sector, right? So house prices went way too high, and then at some point they crashed. And one reason why there was too much investment in the housing sector is not only the low interest rate environment, is also some economic policy decisions that were taken in the US in the late 90s under the Bill Clinton administration. And here they are. The roots of the crisis are therefore mostly monetary, by that I mean the low interest rate environment, but other policies contributed to the problem. And in particular, Fannie Mae, which is the Federal National Mortgage Association, right? Its purpose is to expand the secondary mortgage market by securitizing mortgages in the form of mortgage-backed securities. I'm going to come back on this in a minute, but it's an institution that is very central to the housing market in the US. And they changed the rules. They made it very easy, much easier. It's not very easy, but much easier for poor and disadvantaged household to access credit, right? So they wanted everybody to access housing property, which looks good on paper, right? I wish everybody was a homeowner or an apartment owner, but in some cases, people, when they're not rich enough or when they do not earn enough money, they cannot buy. That's the way it is. So in the US, they relaxed, they decreased the requirements for poor household to be able to take up a loan and buy a house. So they made it easier. So as a result, you had a whole new bunch of people that entered the housing market to buy houses, but they didn't really have the income to pay back the loan, right? So this was adding another layer of risk in this already very extremely optimistic environment we're talking about, which was the 2000 decade, right? So low interest rate, a lot of credit. If you add to that relaxation of credit requirements for poor households who could also buy a house, but you have a recipe for disaster, right? It's all going into one direction, which is higher, higher, higher prices, up to a point where they cannot go any further. So to illustrate this, we're using what we've done. I would like to use actually a balance sheet, right? The balance sheet that we've been working with, and I've removed securities here for simplicity. But assume this is a bank that's lending reasonably, right? So they have some base money, they have some loans, right? 10 grand, 90 grand for the loans with a total of 100. Assume that next to this bank, you have a bank that is lending unreasonably. Right? What does that mean? I mean, it still has 10K at base money, but in terms of loans, it has a much bigger loan, perhaps a lot of them being to poor people, perhaps to poor households, perhaps. Okay? So they were called bad loans in a sense that those were loans to people that do not really have the ability to pay back the loan, right? So two banks, the reasonable bank with a relatively reasonable balance sheet, and the unreasonable bank with a much bigger balance sheet, right? Well, what do you think happened when that bank, those bad loans are not repaid, right? Because people, I don't know, perhaps people lose their job, or they were not really able to pay back the loan in the first place. I'm not sure. So that's going to turn into a loss the for the bank. On this, I wanna quickly jump to the blank slide, because that's something I wanna make sure it's very clear for you. Assume you're a bank and you make a loan to a customer. Let's say $1 million. Okay, you have the customer deposit plus 1 million. Okay, I'm gonna take a very extreme example. So the customer buys a house, a $1 million house, big fat McMansion house, right? But there's a housing market crash, and the new price of the house after the crash, the house price is only 500,000, right? So how is it going to work? So the customer will first spend the money to buy the house, right? So the customer receives the loan and then spends it on the house, right? So that means that for the bank, we'll have reserve minus 1 million. By the time he buys the house, right? So we're still 0, 0. So that's 1 plus 1 minus 1 plus 1 minus 1. Okay. And then, as I said, the house prices go down. So we have the house prices at, oops, what is this? Sorry, what is this? I want to draw a thing. What's wrong with you? Did I pick the wrong tool? Anyway, I'm gonna move back to green. Assume now that so the guy who bought the house is forced to sell it. Okay, so he sells the house, so he recovers 0.5 million, right? Because we know that the new house prices is lower now. Okay, so that means for the loan he will be able to pay back only half of the loan. Okay, minus 0.5 mln. Okay, that means in terms of loans we have a grand total of no, wait a second. So that's I'm going too fast. Okay, so let me rewind a little bit. So number one, put that in red. The customer takes up the $1 million loan. Okay. Number two, that's in blue, so I'm going to put that in blue. Number two, gosh, let me do that again. Number one, the customer gets the $1 million loan and buys a house. Second, here we go. 2, the customer buys the house. So that's what you have here. Okay, minus 1 million. He uses the money on its account to buy the house, and the commercial bank has to transfer the money to whatever other bank that is holding the account of the house seller. Okay. Number 3. I'm going to put that in black. 3. The house is now worth 0.5 MLN. Okay, so there's a housing market crash. Okay, so the guy sells the house. Okay, so that's going to be 4. The customer, and I'm going to put that in green. The customer sells his house. Okay, so he's going to recover plus 0.5 MLN. Plus 0.5 MLN, which means the bank is gonna receive plus 0.5 million from the bank of the guy who is buying back the house at 0.5 million. Okay, so it's all balanced at this stage. Okay, so now, and that's where I wanted to go. It takes a bit of time, but that's important. 5. I'm going to put 5 here. The customer pays back half of the loan because that's all he can do. So we're going to have all the money on his account is going to disappear. So minus 0.5 MLN, and the loan will also be minus 0.5 MLN. All right, minus 0.5 MLN. So look at that. Interesting, right? Because what do we have? Customer deposits, it's a big fat 0. There's nothing left, right? However, there's still a loan outstanding. So here we have 0, but here we do not have 0. Okay, there's an outstanding 500,000 loan that hasn't been paid back. What the hell? Okay. The only way you can, and by the way, the balance, it's still 0 because remember here we had minus 1 plus 0.5, so that's plus 0.5. That's minus 0.5 plus 0.5, that's 0. Okay, so we're still balanced on the balance sheet side. But so we have, what I'm saying is that at this stage we have 0 here and 0 here. Okay, well, plus 0. It's not 0, it's just plus 0. It doesn't change anything. But we have a loan remaining and outstanding. Let's call it a non-performing loan. Okay, that's what it is. And half of the loan that's not going to be paid back. For sure, the guy is bust, right? He bought a 1 million house. He was able to sell it back only a 500,000. Therefore, he's not going to be paying the remaining part of the loan, right? He's not going to do that. So the only way, and that's my point, and I'm going to do that in perhaps in which color? How about orange? I'm going to do that in orange. The only way the only option for the bank is to write off this loan by taking it out of its balance sheet and by writing a loss here. So we're going to put equity loss. Okay. We're going to put minus 0.5 million. Equity loss minus 0.5 million. All right. So that was a bit long, but I think it was, so that's 6. I'm going to write 6 here. The bank writes off the loan, okay? And therefore, its total balance sheet has decreased by 0.5 million. Same here. That was long, but I think it was good, okay? Because we went through the whole process of a very representative situation for what happened in US during this housing crisis. Okay, I'm happy to answer a question here at this stage before we move on. In particular, I want to show you a video. I'm going to take a picture of that. I think it's good. I'm going to reuse that. So no question. All right, then I'm going to move on. I'm just going to capture that. All right. So let's move back to the main lecture notes. Oh, there was a question, but answer it. No, that's not the right slide. So I'm waiting. Someone is typing for a question, probably. So can you share the meaning of minus million on the balance sheet to the market? So I'm going to redo everything slowly, right? But now that everything is already written, it's going to be perhaps easier. So what I'm trying to do here is trying to walk through the process of a bank who makes a loan to a customer, a $1 million loan to buy a house. And the problem is that because the house prices go down, in order when the time comes to pay back the loan by selling the house, the customer can pay back only half of the loan. Okay, so the first step in red, the customer takes up the 1 million loan. So you have the customer deposit plus 1 million, a loan plus 1 million. Number 2, the customer buys the house. So he uses the money on his account to buy the house, and that translates into an interbank payment. Therefore, you have the minus 1 million here. Third, the house is now worth 0.5 million because there's a housing market crash. No translation on the balance sheets yet. 4, the customer sells the house. So when he sells the house, he recovers the money plus 0.5 million, and therefore the commercial bank receives the base money that corresponds. 5, the customer pays back half of the loan. So he uses his money entirely to pay back half of the loan. That's the minus 0.5 million in purple, which you have here. The problem is that you have an outstanding right there loan that is not going to be paid back. So the commercial bank will write off this loan. That's the 6. By removing it from its balance sheet, it removes the other half of the loan, and that translates into a loss. Okay. So that means that the total the total balance sheet, we're talking in net terms here. Maybe I should have this is implicit here, but we're talking in net. Talking in net, right? In the sense that this is just the deltas. We're just looking at the changes in the balance sheet, right? So yes, it's minus 0.5 because the bank gave a 1 million loan and only half of the loan was paid back. Therefore, the other half is lost. And that's why the balance sheet has decreased, the size of the balance sheet has decreased by 0.5 million. So I'm going to repeat what I've just said at the last sentences because I think that it answers your question. Why is that the total balance sheet has shrunk by 0.5 million? For the following reason. The bank has created 1 million of new money, made a loan of 1 million, but only half of the loan was paid back. Therefore, the other half of the loan has to be written off. And that's why we have a loss for the bank. If the customer was able to pay the entire loan, then there would be no loss. Okay, I give you 1 million, you pay back 1 million, fine. But I give you see, so I give you 1 million, you pay back half of the loan. What am I supposed to do? Okay, well, you have to write it off, right? You have to make it go out of your balance sheet. There's no reason for it to sit there. It's because you've lost the money. You're not going to recover it. That's why it turns into a loss, and that's why your balance sheet shrink. So now you understand, I hope, why creating money doesn't go without risk in a sense, because if the money is not paid back, that's going to be a loss. Okay. Yes, sir. Very good. So it looks like you guys understand. It's a good example. It's not an easy one. If a bank bankrupts, the money market will be shaking. Exactly. If a bunch of banks bankrupt, the financial exactly. That's why you have this lender of last resort stuff, right? That's why the central bank, usually people say, that's why the central bank is useful in this situation because it can expand its balance sheet, just create base money and throw it at the banks. Emergency liquidity loans, we've seen that, or QEs, like big open market operations. There's always a way to provide liquidity to those banks. The problem is, and that's what we said, we have this moral hazard problem. Moral hazard means banks know that. They know they have the central bank that has their back. They know that they have this big insurance company that's called the central bank. So they would probably take more risk than if they knew there was no central bank. That's my point. Okay, that's the moral hazard problem. That means the customer gives the house to the bank and the bank sells it. Exactly. That's another way of saying it. In my example, I was just saying the guy sold the house to someone else. It's equivalent, what you're saying. Either the guy sells the bank to someone else, or the guy sells the bank, the bank recovers the house and sells it to someone else. It's the same. In both cases, the bank's going to recover only half of the money that it has created. Okay. And yes, the bank will have to clear the debt of its customers. You cannot have loan that you know is not going to be paid back, right? So that's why it has to be written off. That's the right term here, to be written off. Wait a second. Okay, good. I think it was a good exercise. I didn't realize you would react that much, but I thought it was straightforward. But it's not that straightforward. I mean, even for me, I had to be very slow and very careful in doing that. So hopefully, it's going to be useful. If there is no other question, and I'm glad we did that, I'm going to move back to the main lecture notes. Okay, so that you understand, you can better understand now how we move from this slide, the bad loans that need to be written off, to this slide, right? Now you understand, right? We've removed the bad loans, they're gone, no more bad loans. So we are assuming none of them was paid back, right? In a sense, that's the assumption I'm making. I'm just simplifying things, right? None of those loans were paid back. So that means a loss of 200. So that's going to wipe out. I mean, if the bank loses too much, it's going to wipe out its equity. Right? The bank's going to go bust. It's going to go bankrupt, as your Mrs. Said, right? Huge. So that means huge loss for the bank, right? For the banks. As a result, banks are reluctant to lend to each other because one or several of them may collapse. Okay, banks keep their cash. They know some banks are in trouble. So you've heard that some banks are in trouble. They made some poor investments, so you will be reluctant on the interbank market to lend them. So, but if you're reluctant to lend, and if everybody does that, then the credit market freezes, right? The whole thing stops. Then agent starts fire selling everything to recover cash. So all assets depreciate even further. Okay, so that's tough. Okay, so now to finish the class today, I'm going to show you a video, a good one, um, which illustrates exactly what we said. So this video is a sketch, right? So you have two comedians, John Bird and John Fortune. One plays a merchant banker, sort of arrogant banker, very sure of himself, and the other one plays the role of a journalist who's asking questions to this banker. And it's very funny, but it's also very good in the sense that it's very to the point and very clear explaining the financial crisis. So I'm gonna go to YouTube. Right, so John Bird, John Fortune, subprime sketch. Right, I'm gonna activate the subtitles. All right, so that's the way it works. So share an external video right there. Okay, and we will reconvene after the video, and then we'll stop the class, and I'll take a few questions. Okay. Can you see it and hear it? Good. It is. All right. So thank you for watching. So I'm just gonna uh, move back to how do I exit this stuff? Not even sure. Audio mute. Mm. So first of all, I also find it very funny. So can you hear me, by the way? Yes, good. Because I'm not sure how to go back to my slide. That's embarrassing. Anyway, the time is over now, so I'm not gonna cover anything else. My recommendation to you would be the following. Uh, you try watching it at home. Activate the subtitles. There are a few wrong subtitles. You can look up the chat. I've corrected them. I think it's not only very funny, but it's also very relevant and very good to in terms of explaining what happened and what triggered the great financial crisis, right? So that's why I would say that it would be a good idea for you to watch it again, activate the subtitles. So the comment here, I like the way they describe market reaction when they hear keyword. Yes, that's the funny part. And so he suggests that the only reason why people are investing is because they find the name of the fund that sounds good. Like it's high, better than low anyway, as it says. So no, it's very good. Not only good but also funny. So when you can combine the two, learn and have fun, I think it's good. So I'm happy to take question now. Yes. I'm happy to take question now, whether on this sketch or whether on what we've done today. I'm gonna try to see how to move back to the slides. So any question? You can see that someone is typing. Right, I'm waiting for the questions to show up. It was very interesting movie on 2008 crisis, which yes, The Big Short. Yes, that's right. It's a very good movie. It's a very good movie. Yes, I recommend you watch it as well. I do. Very good. Thank you for your suggestion. How did the financial crisis in US affect the rest of the world? One way of looking at it, we're going to talk about it tomorrow, but one way to look at it is to realize that there are a lot of savings and money that's being managed in the US. For instance, I read some time ago, but it it's probably still true nowadays that market capitalization in the US. So you take the US stock markets, all of them together, the market cap is about 60% of the world market cap. So that's huge, right? So it has a huge impact on the world. So the problem is when there is financial trouble in US, a lot of US investors that have put some money in the rest of the world, they bring it back, okay? Because they anticipate that for good or bad reason, but that's what they think. They anticipate that the crisis is going to hit the other countries, and in particular, when the financial crisis hit a country like Vietnam or Indonesia, not only you lose money through the stock market, but you lose money through the exchange rate because the Indonesian rupee or the Vietnamese dong or the Thai baht, they lose a lot of value on the foreign exchange market. So you really want to move your money back fast because if you don't, not only the stock market depreciate in the country in which you invested, but also the currency. So it's a double whammy, right? It's a double penalty. So yeah, that would be the reason. The investors anticipate that developing countries are going to be hit because those markets are not very liquid as well. It's very hard to remove the money. The foreign the exchange rate is going to depreciate. So that's one challenge. Okay. What can be the signs of a financial crisis? Good question. Good question. Look at credit to GDP ratios in some country. I think that's usually a sign that a good sign. If it goes up too fast, if it's too high, then there's trouble down the road, right? So you can look at that. You can look at the profitability of banks as well. If it starts deteriorating, that means the banks are starting to lend to uh, sort of not very profitable customers, I would say. So, well, from the macroeconomic point of view, I would say that credit to GDP ratio is a very good indicator. Remember the slide I showed you, right, in which you had this ratio in the US. It kind of accelerated during the 2000 decade, right? So, yeah. Any other question? Mm, Nope. All right. Then I guess we're gonna call it a day. So remember that tomorrow is our big day. We're gonna have class in the morning and in the afternoon. In the morning, we're gonna have 3.5 hours and 2.5 hours in the afternoon. So in the morning, I'm probably gonna make a 10, perhaps even 15 minutes break because otherwise it's gonna be too difficult. So morning session, afternoon session. But we're going to have fun because we're going to talk about the crisis as well, use the knowledge that we've done, and in particular, we're going to talk about alternatives to the current monetary system, and such as Bitcoin, for instance. All right. So if there's no more question, I'm going to stop the recording. I'm going to save the share notes, put them on the server, and wish you a very good night. And see you tomorrow morning, guys. Thank you. I still have a few hours to go. It's the afternoon here. All right. See you tomorrow, guys.